Okay. Right, I'm going to start anyway. If you're in your seat or not, I'm going to get cracked on. Welcome to what is the last session of today. I suspect that probably half the people in the room, like me, are on European time. It's close to bedtime now. It's almost 10 o'clock. Stay with us, especially you, John. I can see you flagging away in the front row there. Pons is 172 years old, and it's still going strong. So presumably we can crack on for the balance of the day here. So far, you've seen Alan in his new role. You've seen Nitin in his new role. You have seen 3 divisional presidents in their new role, and you're getting me very much in my normal role. Because this, for me, is a session where the content is pretty pure play finance, to be honest. I'm going to talk about 3 things. I'll talk about our value creation. I'll talk about our capital allocation framework and how we think about how we shift our capital around the business and how we return our capital. And I'll talk a little bit at the end about the savings plans that we have that fuel the growth of the business and keep that flywheel turning. So it's 3 pretty good subjects to finish the day with. As usual, I'm required for the 9th time today to remind you of the safe harbour statements. What a world we live in. I'm sure we all feel really comforted and protected by this. Back in June in Paris, Alan spoke about the 3 beliefs that underpin our Compass strategy. These are 3 beliefs which really anchor together our business priorities and our strategic imperatives. And they are quite simply that brands with purpose grow, that people with purpose thrive, and that companies with purpose last. And if you take the first of those beliefs, I hope today has already given you plenty of examples about just how focused we are in the company on driving growth through brands with purpose. Now, on the second belief, you'll hear Lena, who's our Chief HR Officer, talk about how people with purpose thrive tomorrow. And the third belief, which is that companies with purpose last, is really for this session. And I'd like to focus on how we have delivered and are committed to continuing to deliver superior long-term value. And for us, this means consistent multi-year performance on growth, on margin, and in cash delivery. Even as our markets are, generally speaking, a bit more volatile, so that we can deliver attractive returns to our shareholders. And these are the areas, as I said, that I'm going to focus on today. Let me start with shareholder returns. When we look at our performance, we've increased the market cap of Unilever from about 88 billion euros in 2014 to around about 144 billion euros today. That's an increase of 80% over 5 years. And it's strong performance. It's twice the rate of the AEX index, which increased by 40% over the same period. And it's much more than the FTSE's done over that same time period. So we didn't choose the best and easiest comparator. But, I really think that comparisons like this have a lot more relevance when you look at our performance relative to our peer group. And this chart shows where we've ranked in terms of 3-year total shareholder return over the last 10 years compared to our peer group. And what you see is that we've sometimes been in the top third. We've very rarely been in the bottom third. And really, since 2014, our performance has been strong relative to our peers. Now, Richard, where's Richard? Richard Taylor, you asked this morning in one of your questions, were our plans unambitious? And I just emphasize that it's what we're doing here. It's a really hard thing to do, to be in the top third consistently of your peer group. I think we all recognize that. And you see our performance here, and you see what's happened over the course of the last 10 years with the strong performance since 2014. Looking more closely at recent years, and this is from 2016 now, we've delivered consistent multi-year performance across all the key metrics. Now, our growth has not been in the upper half of our 3 to 5% multi-year growth range over the last 4 years, but we have managed that in 5 of the last 10 years. And I hope, again, from the earlier discussions today, you can tell just how committed this team is to getting back into the upper half of that growth range. If I summarize all of the discussions we've had in the breaks, or at least that I've had in the breaks with many of you so far today, it is a question of that growth, that little bit of growth to move ourselves into the upper half of that range. And our growth has stepped up, as it shows here on the chart. And we have done this in an environment where our markets have slowed, especially across, for example, the big footprint presence that we have in Latin America. And at the same time, as you can see in the chart, we've grown our operating margin as we said that we would. And our delivery shows, and Alan touched on it this morning, that growth and margin improvement can very much go hand in hand when they are managed properly and carefully. And this, in turn, as you see in the chart, has resulted in strong EPS growth. Our margin's gone from 16.4 to 19.3. We've added 300 basis points or so of margin, and that gives us a fantastic platform now for value creation, because as we now grow from that higher margin base, we create much more absolute value per unit of growth and even better returns over time. I'd like to take a look now at our financial growth model. We use this a lot and have done very consistently in the business for a long period of time. When we think about our financial growth model in Unilever, we think about three levers. And it's not rocket science, but it's worth setting out. We think, first of all, about growth leverage. And that's essentially our underlying sales growth and the accretion that we gain from working the portfolio through acquisitions and disposals. The second lever in our growth model is operating leverage. That is driven principally by efficiencies and by margin improvement. And the final lever is financial leverage, which includes pensions, tax, finance costs, and minorities, etc. And as you can see here, over the last 10 years, we've used different levers to drive our financial growth model at different times, always seeking to deliver consistent value for our stakeholders. And I'd give us a pass mark for this, because as you break the last 10 years down into two 5-year buckets, what you see here is that between 2010 and 2014, when commodities were booming a bit and emerging markets were really flying, our top-line growth was the main driver of our earnings growth, cash flow growth, and value creation. And these were also the years of higher catch-up investment in the business, which we spoke about at the time, which kept margins over that period relatively low. But since 2014, we've seen our markets and consequently our growth slow down a little bit. And over the 5 years from 15 to 19, we were able to significantly step up our margin delivery, and that allowed our operating leverage to be the bigger driver of our financial growth model since 2015. At the same time, we worked to get a benefit from financial leverage by managing our pension, our tax, and our financing costs quite efficiently. And I should say, for those who came looking for margin guidance beyond 2020, I just want to repeat what Alan said this morning. We're not giving guidance on margin today, and of course, if that changes, we'll let you know. But we do understand how we create value in this business of Unilever, and we do understand what levers we need to pull in different circumstances. Now, we are very disciplined on cash, and that will not change. Our free cash flow has increased by €1.5 billion over the last 5 years and now stands at well over €5 billion a year. We've doubled down our focus on cash conversion, and we're pleased with the progress that we've made on that. We said we wanted to run the business at around a 100% cash conversion, and that's what we delivered last year in 2018. And that really is quite a significant improvement from where we were just 5 years ago. Now, one of the drivers of this has been an improvement in working capital. That alone has freed up about €4 billion of cash over the last 10 years. Mark mentioned this in his presentation. Having negative working capital consistently for a period of 8 years is good, but to have negative working capital of over negative 5%, I think is better than good, although it has been a little bit tougher to maintain such a strong position as that recently. We have seen a little bit of a deterioration since our lowest working capital level, which was in 2016, but we are very clear what the reasons, what the drivers of that are. Some of them are structural and quite understandable, but some aren't structural, and where they're not structural, of course, we've taken steps to correct that. For example, we did build up stock for a potential no-deal Brexit. We also carry higher stock levels in areas of our business where we're restructuring our factory network. We're doing that restructuring, of course, to get more flexibility and a lower future cost base. But in our big supply chain networks in Europe and in Latin America, we do build up stock levels before restructuring our factory network. And also, as Mark touched on, we have increased our portfolio complexity a little bit with Connected for Growth. We've introduced more SKUs through locally relevant innovation and channel specificity, which Mark mentioned this morning. All of that puts a little bit of pressure on working capital. And more recently, we've had a couple of specific liquidity issues in some parts of the world, such as Africa and the Middle East. And of course, we're managing those situations thoughtfully and carefully. Let me move to Capex, which is another critical part of our cash generation. Now, around 10 years ago, we took the very deliberate decision to step up our Capex levels to over 4% of turnover. And we did that because we had identified a prolonged period of relative underinvestment in the business. Now, a short period of that higher spend allowed us to modernize our fixed asset base. And since then, we've been able to steadily reduce the levels of Capex. This has been helped by the strategic shift to more use of third-party manufacturing across the business as a way of handling that complexity and lowering risk, particularly with regard to local innovations or the new-to-the-world brands that we've been developing. And our Capex levels now sit at around 2.5% of turnover, which we see as a more normalized and sustainable level. Following the strategic review back in 2017, we increased our leverage to approximately 2 times EBITDA. And even with that, we've been able to maintain a healthy single A credit rating. Having that good credit rating is pretty important from the perspective not only of low absolute cost of financing the business, but of course it also affords us a lot of strategic flexibility with our balance sheet, should that ever be useful to us. Our average interest rate on net debt has decreased from around 3.5% in 2016 to 2.2% in 2018, and that's helped to deliver the financial leverage component of the financial growth model that I showed a couple of charts ago. And for simplicity, that's all shown there before the impact of IFRS 16 from 2019, which brought leases into liabilities and net interest cost, of course. And now I'd like to spend a few moments reviewing how we think about capital allocation in Unilever. And essentially, we have 3 broad choices available to us on where we put our capital. The first is what we call operational investment. We will always invest first back into our business, creating the platform and momentum for future growth, creating the flywheel or virtuous circle of growth, as we call it, that works so well for businesses like ours that are focused on brands and on consumers. Operational investment includes Capex and restructuring, where we spend now in order to create the right foundations for the future in our assets, in our capabilities, and in our organization. We also include within operational investment choices around investing in our products and brands, for example, through R&D. And we also include sustainability investment and minority buybacks in this bucket, which I'll come on to in a minute. Now, you could debate whether minority buybacks would sit in portfolio reshape or in operational investment, and indeed we do from time to time. But it's certainly very clear to me that there is no better example of investing back in your business than to buy some of the minorities that you don't own, so you own a little bit more of the business that you already control. The second set of choices for capital allocation is about reshaping the portfolio through acquisitions and disposals, and that can either be a source or a use of capital, of course. And the third group is about returning value to shareholders. So let me talk about each of these. I've already talked about capital expenditure under operational investment, but let me turn to investing to stay future fit. We have to continue to invest to be a future-fit organization. For several years now, digitization and the creation of assets and capability around data in Unilever has been an absolute priority for the entire organization. You saw this at lunchtime today in the digital hubs, and you saw it from Mark with the digital twinning in the supply chain presentation this morning. Now, this includes technology, includes automation, and most importantly, the capabilities of the people that work in Unilever. And not only have we introduced extensive and mandatory digital upskilling and training across the entirety of the business, but in the last 2 years, we've recruited over 1,500 digital roles across all of the functions in the business. And actually, the candidates for this are a mix of internal talent and external talent, such as data scientists or audience insight specialists. We now have 500 people in the business who are dedicated to our 38 digital hubs and our people data centers, which, as I'm sure you know now, are now in over 30 countries. You had a chance to meet a few of them during lunch when we popped downstairs to the digital hubs. And we also make a active and, frankly, unapologetic choice to invest in sustainability. You'll all have seen the challenging targets that we've announced for ourselves on plastic packaging, and this can sometimes bring cost. But as Alan explained this morning, it is very much what consumers want, particularly future consumers, the consumers that are coming into our products. And therefore, it's a very important area of investment behind the future relevance of our brands and our products, your brands and your products. We have to start thinking about that sustainability investment in that way. It's also fully in line with our strategic commitment and our strategic priority to purpose-led brands. And of course, those two things go hand in hand. And all of this, of course, builds on a sustainable living plan, which we should remember was in place well before the UN Sustainable Development Goals were created. And you also know that we're investing about 3.5 billion euros in restructuring spend between 17 and 20 to make sure that we have the right organization and infrastructure in place for the future of the business. The key enabler here is our change program, which I'll come back to in just a few minutes. And at this point, I'd like to digress slightly for a minute. Investment in the long term isn't just about buying businesses. It's not just about restructuring or building new capability. In our business, we sometimes have to make investments now in a brand or in a country for which the return is only going to come some years later. And we do this again so that that virtuous circle, that flywheel that is so important to us, keeps spinning down the line. There are just 3 examples on this chart where we benefit today from investments that we made a decade ago. The first one is Dove Men+Care, which was the very first extension of the Dove brand into the male segment. It started very small. It crossed the 100 million euro mark in 2010. It doubled in size by 2012, and it's now over 600 million euros, which is similar in size, just to anchor it with a reference point for you. That's the same size as our entire business in Russia. And it continues to grow very strongly and will continue to grow strongly from that ever bigger base. The other 2 examples just illustrate where we backed ourselves to grow positions in our emerging markets. You know, we talk a lot about our emerging markets. We love talking about our emerging markets. They're such an important part of Unilever, but they didn't show up by accident. We didn't have the unbelievable footprint that we have and the advantage we have where populations are growing just because by happenstance. This happened through these longer-term investments and having the foresight to develop assets in places that will be a future store of value going forward. There's 2 examples here. It's Mexico and the Philippines, both businesses that have grown to over 1 billion euros each over the last 10 years. You see the average rates of growth they deliver. And we often talk about the early investment and commitment that we have when investing in our emerging markets, and that we're all about growing them into the long term, even in some volatile and difficult environments, such as we're experiencing right now in Argentina and Brazil, for example. But you're going to get the chance tomorrow to talk to Fernando and really get it from the front line of managing through those markets. And what I hope you take away from that is that this is opportunity. This is our bread and butter to operate in these volatile markets. And sure, yeah, it's going to take a bit of growth, a bit of shine off the momentum of the top line of the company for a period of time. But the opportunity and the scale that you create by being in those markets through those moments of volatile change, it's what creates the platform from which you then grow even faster when it comes out. People ask, how did you develop these businesses in emerging markets? Most of it was by managing through crisis. Most of it was by being there when nobody else was there, and therefore creating very strong brands with consumers in those marketplaces and building loyalty that lasts to this day. There's just two examples there. Myanmar and Ethiopia are good examples that sit in the next wave. We are investing on your behalf in Myanmar and Ethiopia because we see the potential for future growth there, and we want to build a strong position that will pay off further on down the line. Another way, as I mentioned, that we've been investing capital back into our business is by increasing our ownership interest, your ownership interest, in subsidiaries in strategic geographies of the company. Over the last 10 years, we've invested over 4 billion euros in minority buybacks. As you can see on the chart, we now own 100% of our businesses in Vietnam, in Algeria, in Egypt, and in South Africa. And also in 2013, many of you will remember, we increased our shareholding of our biggest subsidiary, which is Hindustan Unilever. And since we repurchased those shares, the share price of Hindustan Unilever has increased from 600 rupees to over 2,000 rupees. So a really strong value creation example, especially since we were able to use some of that additional shareholding to fund the acquisition of the Horlicks brand from GSK, which was announced around about this time last year. It is, in fact, the largest acquisition we've made since Best Foods back in the year 2000, and very significant. All of the 34 acquisitions that I'm going to talk about in a minute and that you're constantly asking questions about, they are not all equal. There are 4 or 5 of those that are very big and very significant, and the others tend to be rather small in single country or much more manageable. Increasing the holdings that we have in subsidiaries means that you as Unilever shareholders will benefit more from the future growth in these markets. So we believe that that is a very good use of our capital from time to time when the conditions are right. Now, moving to the second group in our capital framework, portfolio reshaping through acquisitions and disposals. Now, Alan and Sunny and Hanneke and Peter have all described the importance of portfolio change, either first of all organically through innovation on our existing big brands, or secondly through the development of new brands, or thirdly, and this is very much a sequence, through acquisitions and disposals. And it has been a particularly important feature of our capital allocation over the course of the last 5 years. Since 2015, as I said, we've made 34 acquisitions and we've made 14 disposals. Over that time period, if you count the cost, that's 11 billion euros invested and proceeds realized of 8 billion euros. And together, that's almost 20 billion of portfolio churn, for want of a better word, through acquisitions and disposals. And that, we think, is a reasonable level of activity for a company that has a market capitalization of around 150 billion euros. The objective, the sole objective of our M&A strategy is to reshape our portfolio towards higher growth segments. Now, first of all, at a macro level, this means more of our portfolio in high growth segments such as prestige and exiting lower growth segments such as spreads, for a basic example. And while most of the increased scale of beauty and personal care has in fact come from organic growth in the business, acquisitions have also played an important role, and that will be more evident over time as the acquired businesses grow. Now, that was the macro level. At a micro level, we're also reshaping our portfolio within each of our 3 divisions. In food and refreshment, for example, we've made relatively small investments to acquire the Vegetarian Butcher, which Hanneke showed you, to tap into the fast-growing plant-based trend. And we also acquired Graze, tapping into healthy snacking in the UK. In beauty and personal care, we've acquired smaller brands in the natural space, such as Schmidt's Naturals, and created new brands in naturals as well, such as Love Beauty and Planet. And in home care, as Peter and Joey, who manages the business, just showed us, we've acquired 7th Generation, part of the clean and green home care movement. And we've also continued to prune the portfolio. We have done a number of smaller disposals within the divisions. For example, ALSA, which is a European desserts business, and ADES, which is a Latin American soy drinks business. As Alan said earlier, we're still open to M&A, large and small, but we'll continue to set demanding criteria and run a very rigorous process. And as we do that, you may notice a slowdown in the number of acquisitions going forward. At this time of particularly high multiples, we're going to focus on the 34 acquisitions that we've completed in the last 5 years and how we can realize full value, including by rolling those businesses out across our footprint to more markets. And on the subject of talking about M&A, I want to stress that every single transaction, if it's an acquisition or a disposal, goes through the same very consistent and robust process whereby after looking at the fundamental strategic fit of that business, we make a very rigorous assessment of the financial returns and the risks of every opportunity. And we don't get this perfectly right in every case. And I don't think you'd expect that we would get it right in every case. But in aggregate and over the midterm, you can expect that we make good acquisition and divestment decisions. And sitting above this rigorous process is the discipline that we have around return on invested capital. Just to remind you that ROIC is one of the targeted metrics in our long-term compensation plan for 90% of the top 100 leaders in the business. They are all signed up to that. And we've been very clear that we want to keep ROIC in the vicinity of the high teens. And over the last 5 years, we've delivered on that. We've closed a significant number of acquisitions over that time period without significant dilution to our high ROIC. And although we are prepared to see ROIC go down somewhat in the short term, provided that acquisitions meet our financial and strategic criteria, maintaining ROIC, as we have done, has really only been possible because of the strong margin progression we've delivered over the same period. So the margin progression has been the thing that has allowed us to churn our portfolio, moving to faster growth spaces without major dilution of ROIC. And I think Alan has made it abundantly clear already today that growth is our number one priority, and we've managed to balance the capital cost of shifting our portfolio into higher growth segments, but also being able to do that whilst having the discipline to maintain that high ROIC. The last area of capital allocation to examine with you is returns to shareholders. Now, we've always paid, as you know, a regular and growing dividend. We have a payout ratio usually somewhere between 60 to 70% of our earnings. And paying a regular, sustainable and growing dividend is important. To be quite candid with you, it's the first thing I think about on the 1st of January every year when I wake up with the year ahead is, you know, in simple terms, we've got to generate the cash to fund our dividend. We've grown our dividend year on year, irrespective of any single year foreign exchange impact on our earnings. And that can be quite significant sometimes because of our emerging markets footprint, but which over time it tends to round out and revert to a mean. We've also made several event-driven share buybacks in the last couple of years. We see that as a very good way to return excess cash to our shareholders, cash which is beyond that which we need in our capital allocation framework. And it also helps us to grow our earnings per share. For example, we returned 6 billion euros with the proceeds that we got from the sale of our spreads business. Now, historically, our share buybacks have been episodic and event-driven. They've usually been associated with a cash build-up following a transaction. And going forward, we see the opportunity to use buybacks as part of the suite of tools that we have within our capital allocation framework, whilst broadly keeping at our goal of around 2x leverage. Let me turn now to a subject that Alan introduced earlier. With growth our clear priority, I want to review with you the programs that provide us with the fuel that is essential to driving that growth. And these, by the way, are the same well-established and slick programs that have helped to deliver our margin progress in recent years. The three main programs are ZBB, 5S, and the Change program. And together they've consistently delivered €2 billion of savings every year since 2017. So let me just take each of them in turn. Most of you, I think, will have heard of our 5S program. It's a holistic program covering pricing, product sourcing, and product design at the SKU level in every country. It is and will continue to be a really key driver of our savings. It's delivered over €1 billion of savings in both 2017 and 2018. And let me just share with you some examples on the chart of what the teams have delivered as part of the 5S program. In skin cleansing, we've harmonized the 3-day shapes of our liquid hand wash bottles across brands. You can see it's the same bottle shape between Lux and Lifebuoy there. So instead of having different shapes for every brand, we now generally have the same bottle, but we can still very effectively differentiate our brands through, for example, the cap, and as of course the branding on the bottle, what we call the 2D design. And this drives a number of efficiencies for us. In our factories, we don't have to do pack changeovers on lines when moving production from one brand to another. That improves the efficiency and effectiveness of our operational equipment in the factories. We also negotiate better costs with suppliers through having higher volumes of the same bottle. And the change also means minimum change part requirements and therefore lower Capex on the lines in our factories. And last but definitely not least, this change also means a plastic reduction of 20%, which is another cost saving, but just as importantly, of course, a reduction in our plastic usage. It's a great example of the less plastic lever that we talk about when we discuss delivering the plastic goals that we've announced recently. And what this shows is that when we get 5S right, we drive efficiencies, but also reduce plastic usage. And we've got another example of this, which is Dove soap bars. We're now removing the polyethylene layer from our Dove bar cartons and making the cartons recyclable. And that, of course, saves cost, but it also saves plastic as well. Turning now to the second lever of Fuel for Growth, which is our ZBB program. We first introduced ZBB back in 2015, and it really has been a resounding success across the company. Now, I want to caution that not all ZBB programs are the same across companies. Unilever's ZBB program is very broad and it's very deep. We benchmark very actively quartiles of costs across a very wide scope and at a very granular level. And as you can see on the chart, we had different starting points, but also more importantly, very conscious and different levels of ambition within the different cost types themselves. And we've seen the benefits of ZBB for our organization. We continue to extend the model and its philosophy into new areas, and we'll keep on doing that. For example, we've now extended ZBB into digital media, into spending on our trade terms with customers, and into the area of logistics spend. And ZBB doesn't always necessarily mean spending less money, but it also means spending the same money or even more money more effectively. We've created, for example, digital mandatories, or these are best practices for creating our digital assets. And they're proven to deliver greater in-market impact and growth for our brands. Currently, not all of the assets that we produce digitally follow our best practice. But by ensuring that our digital assets follow that best practice, we know we can improve our return on investment by over 30% on Facebook and about 20% on YouTube. So there's a lot of potential here. In 2019, compliance levels with our digital mandatories have already doubled by focusing on that. Another example is bought-in services, where we drive savings through building new global tools and capabilities for our local marketing teams. We've introduced tools that allow us to reduce the risk of duplication and maximize the reuse of assets across our business. And as you know, we've consolidated and we've simplified our agency partnerships to be more efficient and to improve both creativity and consistency. So regional advertising producers, U-Studios, and UniAdapt, all of these tools help our business to improve the quality and efficiency in advertising production, in adaptation of advertising, and in the amplification of the content of that advertising. The third initiative that fuels our growth through driving organizational efficiencies and investing to ensure we're future fit is our change program. We have significantly stepped up the level of restructuring spend in the company. We're now spending around €1 billion a year. The average payback for projects in the change programme is 2.5 years, and we have about 35 projects that deliver over €10 million of savings each. And for us, restructuring is and will be always important to continue to make sure that our organisation is future fit. But we know we have to do restructuring in a responsible way. In regions such as Europe, where a significant part of our cost base sits, this means executing our plans can take a little longer than we would like. And Lena's going to talk about what we call the future of work tomorrow and cover how we're becoming more agile and simple as an organisation. But the future of work also includes principles such as lifelong learning, reskilling and upskilling of existing employees for a different future, and pioneering a growth culture across all of our business. We continue to identify new change projects all the time to sit within this and be future fit. Nitin this morning introduced our thinking on grow, power and run. And as he said, we're still piloting ideas, but we think that within the run space, there is a great potential for efficiency and liberating our resources away from internal processes in order that those resources can get out there and focus on growth. Now, our plan is to take our global business services platform to the next level. It's a Unilever-wide program, and it aims to free the business to grow by transforming the way that we work across all of our functions. It's about redesigning the way that we do the very basics of our business, essentially making it easier to get things done by taking full advantage of future technology pathways. It lets our people focus on consumers, on customers, and on growing the business while delivering efficiencies at the same time. And last, under Fuel for Growth, I want to share with you a great capability that we're developing within our Enterprise Technology Solutions organization. That's our Global Business Services organization. It's called the Automation Factory. Now, this team delivers automation at scale for Unilever. They work with expert partners such as IBM, Deloitte, EY, and Accenture, and they deliver RPA, robotic process automation, for repetitive basic tasks in the company, as well as delivering cognitive automation, which incorporates a little bit of artificial intelligence. It includes things like chatbots, text mining, and anomaly detection. You've heard those things, mentioned in presentations over the course of the day. This is the team that produces the technology that allows that to happen. It has freed up about 1 million hours of work per year. We've deployed over 250 bots in the business, and we've automated over 1,000 processes. And that 1 million hours of work can now be deployed on higher value add activities. It's really another example of how we're investing to be future fit, while at the same time driving efficiencies. So just to wrap up, and as the day draws to a close, hopefully I've been able to give you a few examples of what we've done and what we're doing to drive superior long-term value. We have delivered strong multi-year performance across many metrics. We have a very disciplined and effective capital allocation framework, and we have a healthy pipeline of savings programs that provides the fuel for growth in Unilever today and out into the future. And with that, thanks for listening. Can I take a couple of questions, Richard? I'll take a couple of questions, and then Richard's going to come up and give us the details for this evening and dinner. Hi.
Thank you, Nadeem Rizk at Fiera Capital. So I have two questions on acquisitions. The first one is, obviously, you're mostly like everybody else, selling slower growing businesses and buying faster growing businesses. The issue with that is you're selling them at a much lower multiple, buying the faster growing companies at much higher multiple, and hence your return on capital is actually declining. So the question is, the first one, or it's a comment, unless you can take that business or believe you can take it and make something significantly bigger with it, there's no value for the ultimate shareholder by doing that sort of mathematical exercise. The other question I had on acquisition is you said you're open to both small and large acquisitions. Yeah, you're mostly compensated on ROIC, which I actually like. But then that also can prevent you from making a good acquisition that hurts short-term ROIC just because you're compensated on ROIC. And so, for example, there's let's say a large oral care companies are struggling these days that could potentially be a good fit. I don't know.
Be?
So I hear. That would effectively, mathematically hurt the ROIC significantly, at least on an accounting basis. And so that would make such a large acquisition complicated from that perspective as well.
Nadeem, you've just given half the room a heart attack by mentioning that. I mean, caught in the wrong
I didn't mention the name. I just, nobody knows what the name is.
Okay, all really big points. We could talk for ages about it. Let me start at the end of your second question on remuneration and doing the right thing. You've got to have a REM plan that drives the right behaviours within the business. The second chart I picked up showing the sort of sine curve that happens on TSR ranking, there's no doubt that TSR is the way to align most closely the interests of the people within a company with the people who own the company. There's no doubt about that. But the problem with it is you're a little bit of a hostage to fortune on the timings that happen in a TSR ranking, etc. And that's why a few years back we thought very hard about introducing EPS growth into our long-term target metrics. We have 4 long-term target metrics, so it's not that ROIC is the only one. The reason we put ROIC in is because we believe we're a high ROIC business. We know we create value from our high ROIC. We know it's very important to our shareholders. But when we introduced EPS growth, and there's a lot of funny stuff can happen, particularly in this neck of the woods, when it comes to EPS growth as a metric, we believed that ROIC was a very good counter to that. She would not use cheap debt to buy assets that give you EPS accretion, which is just mathematical, and congratulate yourself for that. ROIC is the counterbalance to that. So there's 25% on each of those 2 metrics. There's also 25% on our compounded long-term sales growth, because we know that growth is what drives value in a consumer company. And the other 25% is on progress with our sustainable living index. We'll talk a bit more about that at a future juncture, but I recommend that all of you, at some point, if you're serious about ESG investing, start to put some form of ESG-related measure into your own performance metrics, because if it's not in your performance metrics, I just don't think you can be that serious about it. So that's the long term. Now, your specific question about what happens if that is done on the basis of our strategy of bolt-on M&A, which broadly speaking has been between 1 billion and 3 billion of M&A activity in any year. If we step beyond that for a transformational or mid-sized transformational in that hypothetical example that you mentioned, at that point, I think you would have to accept that the strategy justifies it. You would be extremely rigorous on the strategic rationale for any move such as that. And of course, the board and the remuneration committee, and we would talk to everybody, of course, you would not stop yourself from doing something that was manifestly in the strategic interests of the company, its shareholders, because there was a ROIC number. So I think you can be confident that when it comes to transformational transactions like that, hypothetically, then you wouldn't allow the short-term impact on ROIC to get in the way of that. But you're highlighting what we all know, of course, which is that there is no silver bullet for any form of remuneration structures. But I think our performance measures are well thought through. I think they're fair, they're balanced, they align the leadership team with the interests of our shareholders, and we think long and hard about that, even to the extent that the changes we made to our remuneration arrangements about 18 months ago were bold. They were leading edge things. We have to, in order to make the same amount of remuneration as a manager now in Unilever, you have to take your short-term reward and you have to reinvest it. You have to reinvest it in the long term into the MSIP program. That MSIP program lasts for 4 years. So in order just to make the same money that you did before, you basically have to do what we ask you to do, which is to invest in our company. And we wanted to do that because we wanted to have more of the people working in Unilever owning more of Unilever. So, we've thought a lot about that. Your first point on the mathematics of accretion and dilution for transactions. M&A starts with strategy. It's one of the most strategic things you can do. In our case, it's about shifting our portfolio to higher growth. And you're right, when you're acquiring higher growth, particularly with valuations and multiples now very closely correlated with growth, they weren't, by the way, 5 years ago, but now they very much are, that can be expensive. And that's why we are saying that we think we'll see a slowdown in our deal flow. In fact, our conversion between everything we look at and transactions that we execute is about 10 to 1. So, the activity system over the last 5 years around M&A has been upwards of 350 transactions that we've looked at in great detail. So we'll always do the right thing when it comes to M&A. As I said, we might not always get it right every single time, but you can be reassured that the processes, the rigor, the strategic thinking, the way we think about our cost of capital, the way we think about deploying that capital is the same every single time. Hi, John.
Thanks, Graeme. On a similar topic, actually, in relation to portfolio change, you said that 20 billion of inflows and outflows for Unilever's market cap is about right over a 4-year period. Is it fair to interpret that statement as indicating a 10 to 15% change in your market cap over the next 4 years? I appreciate it's not linear, but is that a sensible starting point? And then, again, related to the previous question on Capex, you showed that Capex from 2012 to 2018 fell from 4 to 2.8% of sales. And that decline in organic investments obviously correlated with a pickup in inorganic investments. So how much is the lack of further Capex savings a big driver behind you reducing the number of small acquisitions you're making?
Oh, and that's quite a chain. Yeah, I mean, what I hope you picked up from the presentation is that we are always in a very fortunate situation in a company like Unilever, because very rarely are you truly capital constrained. And therefore, when opportunities come at you sequentially, you don't have the luxury of being able to say, well, let's just pause on that. We have a better alternative here, because things tend to be coming at you in a sequential basis. And therefore, you have to sit back and think quite strategically about where you want to invest. And that's why when we think about our M&A strategy, and you know, we were early, I think, within the industry to say our philosophy for portfolio change is bolt-on, not necessarily big transactions. We will keep an open mind, obviously, but bolt-on, was because we saw that as a way of shifting the portfolio in the places that we wanted to get to. It may be that strategy has become a little bit less attractive than it was, because multiples are much, much higher now, and therefore the opportunity to not create value but destroy value has gone up in those situations. So that's how we tend to think about it. We're not, to pick up your point on Capex, really the way to view it is that the increase to 4% and above 4% in a couple of years was a pickup for underinvestment in the preceding years. It was a catch-up level of investment within the business, and brought us up to those levels. Really 2.5, round about where we are today, at 2.8, that's a normalized level of Capex. But as Mark said today, there's an awful lot of the activity that now happens around new brands. Many of the businesses we buy, for example, do not have much in the way of their own supply chain. They're already using third parties. They typically use they certainly wouldn't have significant R&D resources, etc. So there is a different shape to the businesses that we're buying. But as Mark said today, there are still benefits, particularly in the geographies that we're in owning production. It allows you to get scale benefits and allows you to get quality benefits that might not be available in those local marketplaces. So sorry for not really sharply answering your question, but it is a continuum of choice and investing back within the business. I don't think there's any correlation really between Capex spend level, philosophy, and level of M&A. Do you know the thing about the 20 billion? I was wrestling myself, and this was when everybody said, wow, you've done 30 acquisitions, Unilever, you must be spending all your time working on the 30 acquisitions and not thinking about Dove. That is not true. It's absolutely not true. We're completely focused on our core business. And the level of acquisition we've done is in no way a distraction to our business. It was me that I was asking myself, how do you think, what is the right level of Capex? Is there a right level of M&A activity? And I knew the right approach was not to say we've spent 11 billion and we've realized 8, so we've only done 3. That's not true. But all I could think was, well, why don't you just add the two numbers together as a gross in and out? And what is that as a proportion of the market cap? And is it good or bad? I don't know. But you know what? If we'd only done portfolio change of 1% of our market cap, I'd say that we were not using that tool, strategic tool, and that capital allocation opportunity to change our business to higher growth opportunities effectively enough. On the other hand, if we'd done 50% of our market cap I'd say that we had a big strategic problem with the portfolio that we had. So I get comfortable. I'm offer it up. I mean, you might disagree, but when I did that and thought it through that lens, I thought, yeah, it's okay. We haven't, gone crazy on M&A opportunities. Okay, thanks. One more. Anyone want the last question of the day? Jeremy.
Thank you.
Make it a good one. Come on. No pressure.
The pressure's on. So a question on savings and restructuring. So you've indicated that this 2 billion number is kind of like the ongoing run rate, presumably beyond 2020. And so is the implication of that the restructuring cost will also have to stay at the sort of level that we are at the moment? Or do you think you can achieve those savings with a lower level of restructuring costs than you are at the moment?
Great question. Couple of points on restructuring. So we said, and this was it was quite a broad estimate back in 2017, that in order to deliver 6 billion of savings and to change our business, we would need to spend about 3.5 billion of restructuring. That's still a pretty accurate number. I'm actually surprised with how accurate that number has been. But I don't think, we may spend some of it beyond the 2020 phasing. And the reason there principally, as I sort of alluded to in the presentation, is that the ability to restructure in a responsible way, particularly in parts of our footprint like Europe, it just takes longer than we'd anticipated. So I think there'll be a tail going out beyond that. Will it drop down again to the 400 million, 500 million a year? Too early to say, but we will tell you and be clear on what to expect in terms of the cost of restructuring in the business. The one thing to be really clear on is that the payback on restructuring in Unilever comes with really, really nice economics. I mean, to be blunt about it, you're typically talking about the reassignment of labour within the company, and that typically comes with quite short paybacks, 2 to 3 years. And for every single restructuring project we have an NPV, we have a payback period, and we have an internal rate of return on the project of itself. All of that is managed. All of that is in a program office. So we know that when we spend that money, we get a good return on it. The question and the thing that's difficult, Jeremy, is to really be clear on annual buckets of where that phasing will come through. Okay, thank you for the questions. Richard, what are we doing this evening?
Thank you, Graeme.
Thank you.